Just because an asset is overvalued doesn't mean it can't get more so. I'm Jack Otter, editor of BARRON'S.com. I'm with Micah Nero, who writes our income investing blog. So, Michael, I feel like junk bonds have been rallying for as long as I can remember. Yet you spoke to a smart investor who thinks it can actually continue.
The man I was speaking with, Scott Minerd of Guggenheim Partners, made the point that markets that are overvalued can stay overvalued, and markets that are overvalued for a long time are called bull markets. And that's what the junk bond market looks like right now. The average junk bond yields barely over 5%, well below its historic average and close to its historic low. And yet the whole market seems to agree that the junk bonds look overvalued, but there's no immediate catalyst for a big wave of defaults. And the question is, how long can this go on at this level of overvaluation without it being a problem? And there's no obvious answer.
Someone once said, of course, that the markets can stay irrational longer than you can stay solvent. For people who want to play this game but get themselves a little bit of protection, you say that sort of going shorter term will protect you a little bit. In other words, bonds of shorter duration, so that if rates should spike, at least they'll mature quickly.
Right. The average duration of a high yield, or the average maturity of high yield bonds is typically 8 years roughly. And if you're going to buy a high yield bond fund that invests primarily in bonds of that maturity range, then you're going to expose yourself when eventually there will be a spike in defaults, and it's going to come down the road at some point. Some investment funds invest in shorter duration, which means that the duration and the maturities are shorter than that, so you cycle through bonds a bit more rapidly. You don't expose yourself to the longer term risks, and you're giving up a little yield as a result. But there are ways to work with this. A few of the funds that come to mind, both on the junk side and on the investment grade bond side, if you want a shorter term, higher credit quality fund, there's the Guggenheim investment grade bond fund. If you want a mix that's shorter duration of high yield and investment grade, you can go with the DWS ultra short duration fund. And if you want to go short and stick to high yield, Western Asset Short Duration High Income is one such fund, and all of these have done well over the last year and 3 years.
Now, one could argue that even by recommending these funds, we're basically espousing the greater fool theory that someone's going to buy this overvalued stuff at an even more outrageous price. For people who just don't want to play that game in their bond portfolio, what do you do right now?
The key is diversify. I talk to bond investors, professional bond investors, who say they can't find anything across the whole market that they like because everything looks overvalued. So the best thing to do, stay diversified. When you're looking at the riskiest end of the bond market, the junk bond market, and it's only yielding 5%, you're not going to give up too much yield in order to get a little extra safety. So it's diversification, as is often the case, is the best way.
On that depressing note, thanks very much, Michael.